Hello everyone, today's video is all about a recent tax case which caught my eye. I just thought I would share it with you, and specifically all about the tax deduction for writing off intangible assets. So here's the situation. We've got an LLP, a limited liability partnership, and we've also got 4 corporate members. So 4 limited companies which are the partners in a partnership, because a partnership doesn't just have to have individual partners, it can have corporate partners. So in this case, what happened was this LLP was set up, and these 4 partners, or technically we call them members of an LLP, they contributed intellectual property into the LLP. So each of these 4 businesses owned things like goodwill, brand names, customer databases, all sorts of what we call IP, and they transferred it in as consideration, if you will, for being members. So they said, look, we want to own what's going to be going on in this LLP, and we will, we'll transfer in some intellectual property for that right to then receive profits of the business going forward. Okay, so they said that was the commercial arrangement. We'll transfer in some valuable assets, and then going forward, we'll have a share of the profits. All very good. So, fast forward, the LLP is doing its accounts, and the way the LLPs work, they are actually a bit of a hybrid, that they have certain characteristics similar to a limited company and certain characteristics similar to a partnership. And when you draw up accounts for a limited liability partnership, specifically looking at the taxable profit, the tax rules of an LLP say, assume that you're drawing up accounts as if it was a limited company, okay, rather than a normal partnership. So that means that companies get special rules for writing off depreciation of intangible assets. So this LLP basically wrote up its accounts, and it said, oh, we've got all this valuable goodwill that was transferred in from our members. We're just going to write it off in the accounts and get tax relief for it, because there is a more favorable tax relief rule for writing off intangibles if you're a company. Doesn't work so well if you're a partnership. But like I said, the LLP is a hybrid of both, and thankfully, from this point of view, they get to go with the corporate way of writing off intangibles. So, save a shed load of tax in here because the profits are reduced, taxable profits are reduced, which then get divvied up amongst the corporate members. So they're the ones that actually end up paying tax. Remember, an LLP in itself doesn't pay any tax, but its members do. So they pay lower tax because of the write-off of all the intangibles that occurred in here. However, HMRC got wind of that, and they said, no, that don't work. And the reason that they said it doesn't work is because the corporate intangibles rules of writing off goodwill over time cannot occur if the goodwill in question was acquired from related parties. Okay? Now, basically, this LLP argued and said, look, the rules talk about related parties, but they said, look, we're an LLP. We're not a limited company. Yes, we prepare our tax returns as if we were based on the rules, but under the other rules that talk about related parties, we're not. I'm trying to kind of have the cake and eat it, saying we're getting the best of both worlds here. One of the rules says we can do stuff by the rules according to companies, get tax relief. The other one talks about linkage. No, we don't follow that. And basically they went to tribunal, and the court said, look, all of these 4 companies are linked by virtue of the fact that they are members in this LLP. You cannot say that there is no connection here for the purposes of saying, well, we acquired goodwill from a related entity, a related company. Goodwill did come into the LLP from 4 separate entities, and the taxman said that is related, therefore you can't claim deduction for writing off the intellectual property over several years and getting tax relief. So that was denied in the courts, and that big tax write-off that they were hoping for was kicked out of the water. So just a bit of an overview there on intellectual property and writing off goodwill. Something on this was quite a few million at stake here. It's quite a well-known business, but this used to happen on a lot smaller scale when historically, let's say sole traders or partners incorporated and they turned themselves into limited companies and they sold the goodwill of their business into their company, and then over time they wrote the goodwill off. HMRC used to allow that, and then they put the brakes on it. They changed the rules and they said, look, you cannot have this tax deduction on this intellectual property that was acquired from connected entities. And this is exactly what basically happened here. Even though the taxpayer argued that they weren't connected, Tribunal said yes, they were. So just an overview there on the intellectual property rules for corporates. If you like this video, please do subscribe, and as always, I'll see you soon.